3 tests. That's all it takes to know if your money has velocity or if it's trapped. Now, in episode 1 of the Cashflow Hacking Masterclass, I showed you the 4th lever, which we call velocity, and how it can change everything in your personal finances. But here's the question that you're probably asking at this point in time. Okay, Chris, how do I know if my money has velocity? Well, that's what we're gonna cover in this episode. I'm gonna give you 3 simple tests utilizing liquidity, use, and control. And then we're gonna run every major financial vehicle through these tests. Your 401k, your Roth IRA, your real estate equity, your savings account, and even your whole life insurance. And I'm gonna tell you right now, most people's money fails at least 2 of these tests, which means that their money is working once, maybe if they're lucky, and then it's locked away, inaccessible or controlled by somebody else. So let's find out where your money's trapped. Let's go. Hey, I'm Chris Kirkpatrick, and welcome to episode 2 of the Cashflow Hacking Masterclass. If you haven't watched episode 1 yet, I want you to stop right now, go back. I'll click up on the card up below, above here, because this episode builds directly on what we covered, which is the 4 levers of wealth creation in the last video, right? So, quick recap on the last video. Lever 1 is income. Lever 2 is fixed expenses, and lever 3 is variable expenses. Those are the 3 levers that everybody talks about. They tell you to make more and spend less. But lever 4 is about velocity. How many times your money works before it's gone. And we saw what happens when you learn to manipulate that 4th lever. You have the same income, the same expenses, but radically different outcomes. But that raises the obvious question. How do you actually create velocity? What are the actual mechanics behind creating velocity? And more importantly, how do you know if the financial vehicles you're using right now even have the ability to help you create velocity with your finances? They separate money that has velocity from money that is locked, trapped, or controlled by somebody else. So let me show you the test first, and then we'll scorecard your entire financial life. So here are the 3 tests, and I want you to think about the money that you have right now, your 401k, your savings, your home equity, wherever your wealth is parked, and ask yourself, does it pass on these 3 tests? Now, test 1, liquidity. Can you access it within 5 days without penalties, taxes, or having to ask permission to access it? Test 2, use. Can your money keep working while you use it, or does using it for one thing mean that it stops working somewhere else in your life? Test 3, control. Do you decide when, how, and why to use it, or is somebody else calling the shots for you? These are 3 simple tests, but here's the thing. Most of the financial vehicles that you've been told to use, they fail at least 2 out of the 3. Let me show you. So let's start with liquidity. This one seems obvious, right? I mean, liquidity just means that you can get your money when you need it, right? Now, but here's the key. Not just can you access it eventually, but can you quickly access it without penalties, without somebody else's approval? Because I've met so many people who think that their money is liquid, and when they actually need it, they hit a wall. So I had a client. Let's call him Dave. He had about $180,000 in his 401k. He was a good saver, really disciplined, and then his business hit a rough patch. He needed $40,000 to make payroll and keep the doors open. So he thought, okay, I've got $180K saved. I'm gonna take a loan from my 401k. So the first problem, his plan didn't even allow for loans. His 401k plan didn't allow for loans. Some 401ks do, but some don't. It depends on the employer, it depends on the setup of the 401k. So that option for him was completely off the table. His second option was early withdrawal. But the problem is he's 48 years old, so that means a 10% penalty plus ordinary income tax. That $40,000 withdrawal after taxes and penalties, he actually needed to pull out about $60,000 just to net the $40,000 that he needed. And here's the kicker. Even if he was willing to take a hit, it takes 7 to 10 business days to kind of process the entire thing all out. His payroll was due in 3 days, so his $180,000 in savings was completely useless in the moment that he actually needed it. That's the liquidity test. It's not just, do you have the money? It's, can you access it in 5 days without penalties, without taxes, or without needing permission from your employer or the IRS, or maybe even a bank loan officer, right? That's what it comes down to. Now, most qualified accounts like 401ks or traditional IRAs, even Roths to some degree, fail this test. It's technically your money, but the bottom line is good luck using it when you need it most. All right, test 2, use. This is the one that changes everything once you start to understand it. And it's built on a concept that most people have never been taught. And it's the concept of opportunity cost. So here's what I need you to understand. You finance everything in life. Either you pay interest to a bank or you pay cash and lose the ability to earn the interest on the money that you spent cash, because once you spend it, it's gone forever. Fair enough? Now, there's no such thing as paying cash and avoiding interest. What's happening here is you are just self-financing that purchase. That's what opportunity cost is all about. So let me show you what I mean in a real example here. Let's say that you're buying a house. You need a $50,000 down payment. Now, most people think, great, I'm gonna use my savings. I'll put $50,000 down and I'll avoid paying the interest on that portion of the loan. Sounds smart, right? Well, here's what's actually happening. Let's say you're buying a $250,000 house. If you put $50,000 down, which is a 20% down payment, that means you're financing $200,000 at 7% for 30 years. Let's assume you're using a 30-year loan. Now, over 30 years, you'll pay about $479,000 total. That's $279,000 in interest on top of the $200,000 loan. Now, if you put down zero and you finance the full $250,000 at 7%, which most people are not able to do, that would be a payment of about $1,663. Over 30 years, you'd pay about $599,000 total. That's $349,000 in total interest. So by putting $50,000 down, you saved, right? You saved about $70,000 in interest over the 30-year period. And this is where most people stop thinking. See, I saved $70,000 by paying cash for the down payment. Smart move. That's what they think. But here's what they didn't calculate. What did that $50,000 cost you in lost opportunity cost? Because when you locked that $50,000 into the down payment, that money stopped working for you. It's trapped in the house. It's not earning interest. It's not compounding. It's just gone and trapped because the value of that house is gonna go up or down regardless of the level of equity that you have in it, right? Now you might be thinking, well, I could just go get a HELOC and pull the equity back out if I need it. And technically you can, but here's the catch. Banks won't loan you 100% of equity. Most banks require an 80% loan to value ratio, right? Which means that if you have $50,000 in equity, you're only getting access to maybe $30,000 or $40,000 of it. Which means if you have $50,000 in equity, you're not gonna be able to access any money because $50,000 is 20% of the $250,000 value of the house. So that $50,000 that you thought you saved by putting it down, you can't even get it back when you need it the most. It's locked up, it's illiquid, and it's certainly not compounding for you. Now, let me show you the alternative. What if instead of putting that $50,000 into the down payment, you kept it saved and let it grow at a conservative 4.5% rate of return? It's conservative and it's as close to guaranteed as anything you're gonna find in the financial industry. No market risk, just steady compounding growth. So here's what happens. That $50,000, it's growing at 4.5% compounded annually for the next 30 years. It turns into $197,337. $197,337. Now let's compare. By making the $50,000 down payment, you saved $70,000 in interest, but by keeping that $50,000 invested at just 4.5%, you grew it to over $197,000. That's $127,000 more than the interest that you quote unquote saved. So my question to you is, which path actually made you wealthier? The one where you avoided the interest or the one where you let your money keep working and compounding for you? I want you to let that sink in a little bit because here's where it gets even better. Because when you use a whole life policy, you don't just get the growth, you also get the liquidity and the velocity that the policy allows you to take advantage of. I'm going to explain this a little more. When you put $50,000 into a whole life policy and it's growing at 4.5%, you can take a policy loan against that cash value anytime you want without seeking approval. So let's say year 5, you need $30,000 for a business opportunity. You take out a policy loan against the cash value in the policy. This is where the magic happens. When you take that $30,000 loan, the full cash value in your policy keeps growing as if you never touched it. The insurance company loans you the money utilizing your cash value as collateral, but your money stays in the policy compounding uninterrupted. So now your $50,000 is working twice. Once inside the policy, still growing at 4.5%, and once in your business or whatever investment that you're putting the money into. That's the use test. Your money serves multiple purposes simultaneously for you. Compare that to the down payment scenario. When you lock the $50,000 into your house, where it's working once, maybe if you're lucky, if the house appreciates, bottom line is you can't access it. You can't use it for anything else. It's either in the house or it's available to you. You're not getting both when you pay cash as a down payment. And here's the final piece. When you pay that policy loan back and you decide when and how much to pay back, how you structure the loan, that money goes back into your policy and you can use it again. It's like recapitalizing your own bank. You're recycling the same dollars over and over and over. That is what velocity is. So over the 30 years, that same $50,000 isn't just grown to $197,000. You might use it 3, 4, 5 times for different investments. Each time it keeps compounding in the background, and each time you pay it back, you can deploy it again and again and again. That's how the wealthy operate. They don't lock money away. They keep it in motion. Now that's the use test. Does your money keep working while you use it? Can you deploy it multiple times? Or does using it for one thing mean it stops working somewhere else? Bottom line is most vehicles fail this test. Your 401k, once you take money out, it's done. Penalties, taxes, and it stops compounding. Your savings account, once you spend it, it's gone. Your home equity, it's locked until you sell it or borrow against it. And even then, you're paying the bank interest and only getting access to about 80% of it. But whole life, it passes because your money keeps growing uninterrupted while you use it, and you can recycle it over and over again. That's the difference between wealth accumulation and cash flow engineering. That's the difference between wealth accumulation investing and cash flow engineering. All right, test 3, control. Who decided what happens with your money? Now this one might sound obvious. Well, of course I control my money. It's my 401k. But let's think about that for a second. So your 401k, my question is, when can you withdraw it without penalty? Age 59 and a half, right? Did you pick that age? No, the IRS picked that age. How much do you have to withdraw once you hit age 73? The required minimum distribution, right? Did you choose that? No, the IRS chose that. What happens if you have to access it early? Well, you get whacked with another 10% penalty plus taxes again. Who set that rule? Certainly not you. Now let's say you leave your job and you had a 401k loan. What happens? That loan becomes a taxable distribution unless you pay it back within 60 days. Did you agree to that rule? Nope. Your employer's plan and the IRS made that rule without you. Here's my point. You don't control that money. You're simply a participant in a system that someone else designed. The government sets the rules. Your employer chooses the plan. The mutual fund companies decide what investment options you get. All you do is contribute and hope it works out. In my mind, that's not control, that's compliance. Real control means you decide when to access it. You decide what to invest in, and you decide if you want to take a loan or a withdrawal, and nobody, not your employer, not the government, and not your bank, can tell you no. Most qualified plans fail this test completely. Okay, so now you know the 3 tests: liquidity, use, and control. And you've probably heard me talk about these in the past because I talk about them a lot, but now hopefully you understand them on a deeper level. So now we're gonna run the scorecard. I'm gonna take the most common places that people park their money and we're gonna score them honestly as possible, right? Here's the problem. I'm warning you right now that this might hurt a little bit. Bottom line is though, you need to see it. So let's start with the big one. 401k. This is the golden child of financial advice. Every financial advisor out there, almost probably 95% of financial advisors just scream, max out your 401k, get the employer match. It's free money, right? Sure. But does it pass the 3 tests? Once again, I don't believe in good or bad. Is it aligned or misaligned with what you're trying to accomplish? Now, liquidity. Can you access it in 5 days without penalty? No. Early withdrawal equals a 10% penalty plus taxes. Even a loan takes a week to process, and not even all plans allow you to take a loan even if you want it. So your 401k fails liquidity. That's the bottom line. Your 401k use. Can you use it for multiple purposes at once? Absolutely not. Once it's in the 401k, it's locked into that account. You can't pull the $20,000 out and buy a rental property and still have it keep growing inside of the 401k. The bottom line is it's either in the account or it's deployed elsewhere. You can't have both. So it fails the use test. Control. Do you decide these rules? No, you don't. We just talked about this, right? The IRS decides when you can withdraw. Your employer decides the investment options that you have, and RMDs, if you end up actually having success with the account, the required minimum distributions when you hit 73 years old are mandatory. So your 401k scores a big fat 0 out of 3 on the 3 tests, the liquidity, use, and control. And the sad part here is this is the vehicle that we're told to prioritize above and beyond anything else. No liquidity, no velocity, no control. But hey, at least your employer is gonna match you 3%, right? Okay, what about the Roth IRA? Now, people love Roths, tax-free growth, tax-free withdrawals, true. These are all good things, but does it have velocity? Now let's take a look at it. The first test, liquidity. Can you access it quickly without penalty? Well, kind of, you can. You can withdraw up to your contributions anytime without penalty, that is true. But the earnings on your money, those are locked away until you're 59 and a half, or you're gonna pay taxes and penalties to access that money. So, bottom line is it's a partial liquidity. So we're gonna give this one half credit. Now let's talk about the use test for Roth IRAs. Can it work for multiple purposes at once? The bottom line here is the answer is no. If you pull money out for a down payment, once again, it's gone from the Roth. It can't be in 2 places at the same time, leveraging and utilizing both. So it fails that test as well. And then finally, let's look at the control test. Do you set the rules? Well, this is another partial answer. You can control when you contribute and what to invest in. That is true in a Roth IRA, but the IRS still controls the withdrawal rules, the income limits, and the contribution caps that you have. So we're gonna give this one a partial control. So I'm gonna say this is about a 1 out of 3. Now it's better than a 401k, but still not built for velocity. It's a long-term wealth accumulation tool, not a cash flow tool. All right, so what about home equity or equity inside of a rental property? Now, a lot of people think that, well, real estate is an asset, right? That's gotta pass. Well, let's take a look. And this is interesting for me because you guys know how much I love real estate, right? So let's take a look at the liquidity test. Can you access your equity in 5 days? Heck no, absolutely not. You are not able to access your equity that fast. You either need to sell the property, which can take 30 to 90 days minimum, or you need to get a HELOC or cash out refinance, right? These things all take weeks and require the bank's approval. So it fails the liquidity test. So now let's talk about the use test. Can your equity work for multiple purposes at once? Sad answer here once again is no. If you have $300,000 in equity sitting in your house, that equity isn't doing anything. In fact, I would argue that equity inside of your rental properties and real estate in general is one of the worst places to keep your net worth because that equity isn't doing anything. It's not generating cash flow. It's not compounding. It's just there waiting for appreciation. So it fails, once again, the use test. So let's talk about the control test now. Do you control it? Not really. You can't touch it without the bank's permission. You can't, and the bottom line is you can't sell half your house. And if the market crashes, your equity evaporates and there's nothing that you can do about it. So it fails control. Ironically, as much as I love real estate scores a 0 out of 3. And here's the painful part. I've met people with $500,000, $700,000, even $1 million in home equity, and their cash flow broke because equity without liquidity is just a number on a balance sheet. It has nothing to do with your lifestyle. Okay, so here's the last one. Properly structured whole life insurance. And I'm gonna tell you right now, this is the one that passes all 3 tests. I'm not gonna explain it to you right now. We're gonna save that for next episode where I'm gonna go way deeper into exactly why and how. But for now, I just want you to see the contrast. Now, let's do the test. Liquidity, the liquidity test. Can you access the cash value in 5 days? 100% yes. Policy loans are typically processed in 48 to 72 hours. No credit check, no application. You just gotta fill out a loan form and they can wire the money right to your bank account. So check mark, it passes the liquidity test. Now let's talk about the use test. Can it work for multiple purposes at once? The answer is an astounding yes. This is the key to the entire system. When you take a policy loan, the money in your policy keeps growing as if you never touched it. So you're using the money elsewhere and it's compounding inside the policy at the same time. This is the best of both worlds. All right, so it passes that test. Now let's talk about the control test. Do you decide the rules? Well, yes, you actually do. You decide when to take loans, how much, and when to pay them back, because the loans that you take are completely unstructured. Now, that comes with a little responsibility, and you have to learn how to navigate that. But the bottom line is, the insurance company doesn't care what you use it for. There are no required minimum distributions. There are no age restrictions. So when you look at this, it passes the control test. You are in control. So when we look at this, whole life insurance scores a 3 on the liquidity, use, and control test. This is the only vehicle that passes all 3 tests, and that's why it creates velocity. Now, I know what you're thinking. How does the money keep growing if I take it out? What about the fees? What about the death benefit? These are all great questions. And I'm gonna answer every one of those questions in the next episode. So here's where we are right now. You now know the 3 tests: liquidity, use, and control. You now know that most of your money fails at least 2 out of the 3 tests. And you now know that whole life insurance, when it's structured correctly, is the only vehicle that passes all 3 of the tests. But here's the next question. Okay, so if whole life insurance is the tool, how do I actually use this tool to build wealth? Because that's the thing that I hear more than probably anything else based on the content that I create. Once again, that's what we're gonna cover in the next video. I'm gonna cover the 3 risk buckets, because having a tool that passes the 3 tests that we just talked about are great, but if you don't know where to deploy your money, you're just gonna be shuffling cash around with no real strategy, and obviously strategy is the key to success here, right? So in episode 3, I'm gonna show you the 3 buckets where all of your money should be flowing in your life to be able to actually create wealth and create the lifestyle and freedom that you're seeking. I'm gonna show you how to allocate across all these buckets based on your income level, whether you're making $80,000 a year or $500,000 a year. Because I hear that all the time. People are asking me, well, I don't make that much money. Can you show me a lower level? I'm gonna spread it out across all these levels. Because here's what I believe. Just having velocity without a system can create chaos in your life. And the number one problem, I guess I'll say, that I hear from people that get into this system is that they just don't understand how to leverage it properly. So before you click over to episode 3 now though, do me 2 favors. First, hit that subscribe button for me, please. If you're not subscribed, and I know a high percentage of you, actually 70% of you that watch my videos are not subscribed. YouTube is not gonna show you the rest of this series unless you're subscribed. And trust me, the next episodes, 3, 4, and 5, build directly on what I just taught you. Right? So make sure you subscribe right now and click the bell, that way you're notified when those videos actually get launched. Second, drop a comment below and tell me, which test did your money fail? Was it the liquidity? Was it the use? Was it the control? Was it a combination of all the above? Are you just in a situation where you're feeling trapped because you're failing all the tests and you don't know what to do to fix it? I promise you, by the time you get to the end of this masterclass here, you're gonna have all the answers that you need. All right. So that's episode 2. You now know the 3 tests: liquidity, use, and control. You now know that your 401k fails all 3, sadly. You now know that velocity requires all 3 of the things: liquidity, use, and control, for you to be able to actually implement it. Now, episode 3 is gonna drop next, and I'm gonna show you how to build this system and the key to building the right structure for you to have the financial success that you're after. I can't wait to see you there.